All right, so today we're going to be diving into something that I think a lot of people find pretty confusing, these Fed rate cuts, that is. And we're going to try to break down, like what happens when the Fed cuts those interest rates. I feel like so many people are ready to jump into investing and then bam, the Fed's rate cut. And everyone's like, wait, should I change what I'm doing? Is this good news, bad news? I don't know. It's just a lot to process. And so that's what we're going to try to break down for you today. And we're going to be focusing specifically on those seemingly small percentages, because I think that's the other thing that really throws people off. What's the actual difference between, a 0.25% cut versus a 0.5% cut? So,
yeah, it's really easy to just see the headline and kind of just go with the flow. But, really understanding what's going on beneath the surface, that's where the real insight is.
Totally. And I think before we even get into that 0.25% versus the 0.5%, can we just take it back to basics for a second? Just why does the Fed even cut these interest rates in the first place? What are they hoping to achieve by doing that?
Yeah. So, the simplest way to think about it is the Fed is trying to stimulate the economy by cutting rates. So, you can think of it almost as giving a little boost, encouraging those businesses to invest more, to hire more, and then giving consumers a little bit more spending power as well. Because if rates are lower, it means that things like loans become cheaper, which then can lead to, more economic activity.
So it's a calculated boost to the system. It's not everybody floor it and let's see what happens.
Exactly. Yeah. It's all about, controlled growth, not some crazy out of control surge, because that obviously leads to other issues down the line.
Right. And so that brings us to that 0.25% rate cut, which I feel that's them tapping the brakes a little bit. Or maybe easing into it, I guess would be a better way to say it.
Yeah, I think that's a good way to put it, because it's really a signal to the market that, the Fed is being proactive, but also remaining pretty measured in their approach. They're not hitting that panic button just yet. They're just, more so focused on making sure things are moving at a healthy pace.
Okay, so if the Fed does decide to make that gentle nudge with the 0.25% cut,
right,
what can we, what's the typical market reaction to that? What should people be expecting to see?
Yeah, usually investors see it as a net positive, not necessarily a reason to go pop champagne or anything, but it does, typically we see a little bit of a stock rise just, as confidence increases slightly. But it's not usually anything super dramatic.
Not a sell everything you have and go all in on tech stocks kind of moment.
Yeah, exactly. It's more of a stay the course.
Yeah.
Things are looking up type of signal. Especially for those who are in it for the long haul with their investments.
Right. And I think that's an important point. For those long-term investors, what's the main takeaway when they see that 0.25% cut?
I think it really just reinforces how important it is to be patient and, to really make sure you have that well-diversified portfolio. Because this kind of cut is showing that the Fed is much more focused on that slow and steady kind of growth, over those quick, unsustainable gains. And that's ultimately what benefits somebody who's, thinking long-term.
It's slow and steady wins the race, right?
Exactly.
But let's be real. Sometimes you need a little more than a gentle nudge. So when the Fed decides to make a bolder move and do a 0.5% rate cut, what happens then? What are they trying to tell us?
Yeah, that 0.5% cut, it definitely gets the market's attention, because now it's signaling a much stronger commitment to stimulating that economy. And that often, leads to a much more enthusiastic response from investors.
Okay, so enthusiastic how?
Yeah.
Are we talking full-on stock market party?
Not quite a party, but you'll definitely see a surge in buying activity, for sure. Because investors see that bigger cut as okay, wow, the Fed is really serious about this. They really want to boost that growth. And then you get that fear of missing out that kicks in.
Oh, that classic FOMO.
Exactly.
So it's a psychological trigger almost.
Right.
When you see that 0.5%, it's okay, things are really moving.
Yeah, and that usually means that risk appetite increases as well. So investors just feel more confident overall. They're willing to make some bigger bets, and that can push stock prices up very quickly.
Which is exciting on the one hand, but then, of course, there's always that risk, right? I mean, we can't talk about rapid growth without talking about inflation. So is there a danger that this 0.5% cut could overheat things too much?
Yeah, and that's the balancing act. The Fed has to walk this very fine line, because a larger cut is meant to, really jumpstart things. But you have to manage it carefully, because it can definitely lead to inflation if you're not careful.
Because as the economy heats up, if it heats up too fast, that's when you start to see those prices going crazy.
Right, exactly. And then over time, that erodes everyone's purchasing power.
Right. It's like you said, a balancing act. So both the 0.25 and the 0.5 have their own pros and cons. But how does an investor actually trying to figure out, okay, which one of these scenarios would be better for my own, portfolio and my own goals?
Well, you really have to start with a really solid understanding of what your financial goals are, what your risk tolerance is, and then like the specific sectors that you're invested in. Because, certain sectors are much more sensitive to these interest rate changes than others.
Oh, okay. I've never thought about that. What kind of sectors would be like?
Yeah.
More sensitive than others?
Yeah.
More sensitive in what way? Like what comes to mind?
So like real estate is a really good example because when rates are lower, that means mortgages become cheaper. And so then typically more people are able to buy homes. So you have more activity in that housing market. So for an investor who's really heavy into real estate, a 0.5% cut, that could make a really big difference for them.
Right. Yeah, that makes total sense. So it's almost like you have to think about how those cuts are going to impact those individual sectors, not just like the overall market.
Yeah, exactly. And then on top of that, you also have to keep in mind something called market expectations. Because sometimes the market reaction isn't even really about the rate cut itself. It's about how that cut kind of lines up with what investors were already expecting.
Oh, so it's like they've already kind of priced in a certain level of, action from the Fed.
Exactly. And so, for example, let's say that investors were anticipating a 0.5% cut, but then the Fed only does a 0.25%. Even though, like, logically a rate cut is good, you might actually see the market dip a little bit.
Yeah.
Because it seems like the Fed isn't really doing enough to, address whatever those underlying economic concerns are.
Oh, wow. That's really interesting. It really just shows how important it is to like actually stay informed.
Right.
And not just blindly follow what everybody else is doing.
Yeah, 100%. You really have to understand the why behind their decisions, not just react to the what.
It's like we've been saying this whole time. It's really about understanding your own financial goals, what level of risk you're comfortable with, and then doing your own research to really understand how these big picture things can impact your own money.
Exactly. Because at the end of the day, nothing can really replace, having that knowledge and having that carefully considered investment strategy.
Absolutely. Well, this has been super insightful. Any final thoughts for our listeners out there as they're trying to, wrap their heads around all of this?
I just say don't let that fear of missing out, really dictate, how you make those investing decisions. It can be really tempting to see a 0.5% cut and think, okay, this is it, I'm going all in. But just remember those short-term gains, those don't always equal long-term success.
So true. Sometimes the smartest thing you can do is nothing. Well, thanks again for taking the time to really break all of this down with us. For everyone listening out there, remember, stay informed, and as always, keep investing wisely.